Welcome to Atomic Alpha.
Greetings, citizens of the economic frontier. I am Commander A, your guide in the turbulent world of global finance. Today we're facing a significant threat, a phenomenon that has sent shockwaves through markets worldwide. We're talking about the recent unwinding of the yen carry trade, a strategy that once seemed invincible, but has now become a source of chaos. Join me as we dissect the strategy, explore how it connected the global markets, and understand how its unraveling led to a market capitulation. To begin our journey, let's first understand the mechanics of the carry trade, a strategy that, on the surface, seems almost too simple to fail. The concept is straightforward. Investors borrow money from a country with very low interest rates, and in this case, we're talking about Japan, where rates have been near zero for decades. With these borrowed yen in hand, they then invest this capital in asset that offers much higher returns. These assets could range from the government bonds in emerging markets like Mexico or Brazil to high-flying tech stocks in the US, or even cryptocurrencies like Bitcoin. Why does this work? Well, as long as the yen remains weak and the interest rates in Japan stay low, the cost of borrowing remains cheap. This allows investors to pocket the difference between the low borrowing cost and the high returns on their investment elsewhere. This tactic is known as the carry. When the yen depreciates, as it has been doing for years, the value of the debt decreases in real terms, making this trade even more profitable. Now, citizens, let's delve into why the yen carry trade became such a powerful force in global markets. This strategy wasn't just limited to a few savvy traders. No, it became widespread so much that it interconnected economies and financial markets across the globe. Here's how. Well, the first element is the currency impact. As yen was borrowed and then converted into foreign currencies to buy higher yielding assets, it led to the appreciation of those foreign currencies, like the Mexican peso and the Brazilian real, while simultaneously keeping the yen weak. This created a reinforcing cycle where a weak yen fueled even more borrowing, driving up the value of emerging market currencies and their assets. Second element, the stock market influence. The funds from these carry trades didn't just flow into bonds or currencies, they also poured into global equity markets, particularly into high-growth stocks like those of Nvidia or other US tech giants. This influx of capital from the carry trade helped push these stocks' prices higher, creating a feedback loop where rising asset values attracted even more investment, further fueling the carry trade. And now, third and last element of the equation, the global bond markets. While this strategy wasn't just about equities and currencies, the carry trade also heavily influenced bond markets, especially in emerging markets where yields were much higher than in developed economies. As capital flowed into these bonds, it pushed their prices up and yields down, making them even more attractive to carry traders and fueling a boom in these markets. Now, with great power comes great risk, citizens. The carry trade created a reflexive feedback loop, a situation where the success of the strategy reinforced the condition that made the strategy profitable in the first place. Here's how the whole thing worked. As the yen weakened, more investors piled into the trade, further weakening the yen. As more capital flowed into global assets, those assets rose in value, making the trade even more attractive. Rising asset prices attracted more investors, who then borrowed more yen, completing the cycle. This loop tied together global equity markets, bond markets, and currencies in a web of interdependence. The stability of this system relied on one single element: the continuation of low interest rates in Japan and a weak yen. But as we know, nothing lasts forever. One day, the tide turned. The global economy began to show signs of strain. Growth was slowing, recession fears loomed large. Investors, always wary of risk, began to unwind their carry trades. But unwinding wasn't as simple as closing a position. It set off a cascade of effects that rocked global markets. As traders began to buy back yen to repay their loans, the currency surged in value. This sudden appreciation of the yen made debt more expensive to repay, forcing even more traders to unwind their positions to avoid losses. It was a classic case of a self-fulfilling prophecy. Panic led to more panic. This caused a massive sell-off in global assets, particularly in those that had benefited the most from the carry trade. The impact of this unwinding was felt far and wide. In Japan, the stock market saw its worst one-day decline since the crash of 1987. In the US, tech stocks like Nvidia, which had benefited from the influx of cheap capital, saw sharp declines. Emerging markets, which had attracted so much of this carry trade capital, experienced a brutal exodus as currencies like Mexican peso and Brazilian real plummet. And then there's the Federal Reserve, and they get caught in an impossible bind. As this unwind accelerated, the Fed found itself in a no-win situation. Here's the dilemma. If the Fed cuts rates aggressively to combat slowing economic growth, the yen could strengthen even further, exacerbating the carry trade unwind and triggering a market crash. If the Fed cuts rates slowly or not at all, the US economy could tip into recession, leading to a collapse in asset prices as the wealth effect dissipates. In either scenario, the result could be catastrophic for global markets. So, what does that mean for us, brave pioneers of the economic frontier? Well, the path ahead is uncertain and filled with challenges, but not all is lost. With careful analysis, strategic thinking, and steady hand, we can navigate through this turbulence. The yen carry trade may have been unwound, but opportunities still exist for those who can adapt and think ahead. Here at Atomic Alpha, we are committed to guiding you through these volatile times. We'll explore new strategies, identify emerging trends, and help you position yourself for the next wave of opportunities in the financial markets. The storm may be fierce, but with the right tools and knowledge, we can chart a course to a brighter financial future.